If you earn $25, a year, you are more likely to be audited by the IRS than if you earn $500, Not slightly more likely, 4 times more likely. You read that again, $25, a year. 4 times the audit rate of $500, a year. This is not an error in the data. This is not a glitch in the system. This is the system working exactly as it was optimized to work. And the optimization logic minus the specific, documented, entirely rational reason why this is true minus is something almost nobody has explained until now. The data comes from the IRS itself, not a leak, not a whistleblower. The IRS data book, minus a public document, published annually minus contains the audit rates by income level. The findings are consistent across years. Taxpayers earning under $25, who claim the earned income tax credit, audited at a rate of approximately 5.5 per 1,000 returns. Taxpayers earning funda $500,000 to $1, audited at a rate of approximately 1.3 per 1,000 returns. Taxpayers earning over sudden 1,000 万, audited at a rate that has declined every year for a decade, reaching historic lows in recent years. The relationship between income and audit risk runs in the wrong direction. As income rises, audit probability falls, not linearly, not slightly, dramatically. The people least able to navigate an audit minus least likely to have an accountant, least likely to have documentation organized, least likely to have the time and resources to respond correctly, and on time minus are the people most likely to receive one. The people most able to navigate an audit minus with teams of tax attorneys, organized records, and the resources to contest every finding minus are the people least likely to ever face one. This is not an accident of history. This is the arithmetic of a specific budget decision made inside a specific agency over a specific decade. To understand why, you need to understand what an audit actually costs. Not what it costs you, what it costs the IRS. A correspondence audit, minus the kind, the IRS, runs on low-income filers minus costs, approximately $140 per case. It's automated. A letter goes out, the taxpayer responds or doesn't. The system processes the response. A determination is made. No agent spends significant time on the file. An audit of a high-income return minus the kind required to evaluate a complex return with pass-through entities, offshore accounts, partnership income, and sophisticated tax structures, minus costs between $10,000 and $30, per case. It requires specialized agents, months of document review, legal interpretation of tax positions that may be contested and litigated. The IRS is not funded to run $20, audits at scale. It is funded, barely, to run $140 audits. So it runs $140 audits. The Earned Income Tax Credit minus the IDITC minus is a tax credit for low to moderate income workers. It was designed to support working families. At its maximum, it pays approximately $7.400 to a family with 3 or more children. The IDC is the most audited line item on any tax return in the United States, not because IDITC fraud is widespread. The IRS's own data shows that a significant portion of IDITC errors are not fraud, minus they are mistakes, incorrectly calculated credits, eligibility misunderstandings, documentation gaps. The errors are made more often by people who can't afford a professional to prepare their return. The errors are audited more often because the audits are cheap. The algorithm doesn't distinguish between fraud and mistake. The algorithm distinguishes between cheap to audit and expensive to audit. Let's run the numbers the IRS runs. A correspondence audit of an ITC claimant costs $140 and on average recovers Gundy Sidden. 300 inches, incorrectly claimed credits, return on investment, approximately 23.1. An audit of a taxpayer with income over $10 million costs $20,000, and when it actually recovers anything, recovers substantially more minus, but the complexity, the litigation risk, and the resource requirements make the expected return per dollar spent significantly lower for an underfunded agency operating under a congressional budget that has been cut by approximately 25% in real terms since 2010. The arithmetic is not complicated. You audit the $140 cases. You do not audit the $20, zero cases. You call this resource allocation. The IRS calls this resource allocation. The GAO has called this resource allocation. Nobody has called it what it also is, a tax on poverty. Because when a low-income worker receives an audit notice, when the letter arrives with the government seal and the balance due and the deadline, minus the costs they bear, are not just financial. The time cost of responding to a correspondence audit, 8 to 12 hours on average. For a worker earning $15 an hour, that's $120 to 100, 80 inches lost wages, minus assuming they can even take the time. The stress cost, documented in multiple studies. Audit notices produce measurable anxiety responses. For low-income filers who have less financial buffer and fewer professional resources, the response is more severe and more sustained. The error cost, low-income filers who respond to audits without professional help are significantly more likely to receive an unfavorable determination, minus even when they were originally correct. The IRS recovered $300. It cost the filer sowine, 180 inches wages, 10 hours of time, and a determination that may have been wrong. Now run the other side. A hedge fund manager earns $50 million in a year. His return is 200 pages. Partnership income from 14 entities, carried interest treated as capital gains, foreign tax credits, depreciation on real estate holdings, conservation, easement deductions, a private foundation that reduces taxable income while funding projects he controls. Every one of these positions is legal. Several are aggressive. Some are in gray areas that have been litigated and remain unresolved. The IRS would need a team of specialists, 6 to 18 months, to audit this return properly. The IRS does not have that team available. The hedge fund manager's firm employs a tax attorney, a team of CPAs, and a specialist in tax controversy, minus a lawyer whose entire career is defending complex returns against IRS examination. The attorney fees alone, if the return were audited, would exceed $500 zero. The IRS knows this. The hedge fund manager knows the IRS knows this. His return is filed. His return is not audited. The positions on his return, minus the aggressive ones, the gray area ones, the ones that a full examination might challenge minus go unexamined, permanently, because the statute of limitations on an unfiled audit runs 3 years. After 3 years, the positions are locked in. The savings on those positions, minus the tax that was not paid on income that was legitimately earned, minus may exceed $10 million. The IRS never looked. Not because it approved. Because it couldn't afford to look. There is a number the IRS uses internally. It's called the tax gap. The tax gap is the difference between taxes legally owed and taxes actually collected. Current estimate, approximately $688 billion per year. $688 billion in taxes, legally owed that are not collected. Not taxes that were avoided through legal planning. Taxes legally owed and not paid. The IRS estimates that approximately 70% of the tax gap comes from individual and business underreporting of income. The largest contributors to the tax gap are not low-income filers claiming IDC. They are high-income individuals and businesses with income that is not subject to third-party reporting, minus self-employment income, business income, capital gains from assets, not automatically reported by brokerages. Income that flows through structures specifically designed to reduce visibility. The IRS audits the visible, cheap to examine income. The invisible, expensive to examine income fills the FODA, $688 billion gap, and because the IRS doesn't collect $688 billion in legally owed taxes every year, it is perpetually underfunded relative to the scale of the problem. It's supposed to solve. The underfunding reduces its capacity to audit complex returns. The reduced capacity increases the gap. The increased gap increases the underfunding. The loop runs. The IDC filer at the bottom receives a $140 audit. The hedge fund at the top fills the gap. The system is not broken. The system is closed. The Inflation Reduction Act of 2022 allocated $80 billion to the IRS over 10 years. A significant portion was designated for enforcement minus specifically for building the capacity to audit high-income and high-wealth taxpayers. The stated goal, close the tax gap at the top. Within 2 years, approximately half of that funding had been clawed back through subsequent congressional action. The new IRS commissioner pledged publicly that audit rates for taxpayers earning under $400 would not increase. The hedge fund manager's return remains unaudited. The IDC filer's audit rate has not meaningfully changed. Here is the thing about system: they don't change. Because the problem is identified, they change when the incentive structure changes. The IRS audits the poor more than the rich, not because anyone decided this was just, not because anyone sat in a room and said, let's target the people with the least. It happened because underfunding plus automation, plus the economics of audit cost, produced a system that optimizes for yield per dollar spent. And the people with the lowest incomes produce the highest yield per dollar spent, because their returns are simple, because they can't fight back, because $140 runs faster than $20, zero. The algorithm doesn't have a conscience. The algorithm has a budget, and on a budget, the poor are always the most efficient target. The letter arrives. Government seal, IRS letterhead. Your stomach does the thing it does. You earn $24, zero a year. You claimed the earned income tax credit. You qualified for it. You may have made a small error in the calculation, minus not fraud, a mistake, the kind a professional would have caught. You don't have a professional. The letter costs the IRS $140 to generate. 3 miles away minus different neighborhood, different zip code, minus a 200 page. Return sits in a filing system, unexamined, not because it's clean, because it costs $20, zero to look. The IRS has a budget. On a budget, efficiency is everything, and you are efficient. You are $300 at $140 per case. You are 23, one return on investment. You are the algorithm's optimal target, not because you cheated, because you are cheap.